Hi everyone. In this video, we are going to analyze financial statements and interpret our analysis. We are going to start by defining gross and net profit margins. There is revenue at the top line, and then there is cost of goods sold. The difference between the two, revenue minus cost of goods sold, is called gross profit. The gross profit margin, when it's margin, typically it's a percentage of something, and in this case it's percentage of revenue, is the portion of the revenue that goes to profit. In other words, it's basically the gross profit divided by revenue. Profit margin or net profit margin, on the other hand, is basically you take gross margin, which was again revenue minus cost of goods sold, minus all other operating expenses, including tax expense. You are going to get net profit. And then net profit divided by revenues is the profit margin, or sometimes called as profit margin. We are going to continue with our definitions. There is a concept called cash conversion cycle, which is basically how fast a company can buy parts, make products, sell the products, and get paid for the sale. Obviously, you are going to buy the products, and then the products are going to stay in your inventory, and you are going to sell them, and afterwards you are going to collect the money. So the cycle, the number of days in that cycle between when you pay the money versus when you collect it from the customers is the cash conversion cycle. We are going to define all these in a second, but it's practically, it incorporates the accounts receivable portion, the days that the item is sitting in the inventory, and then minus, obviously, you won't pay immediately your suppliers. There is also some credit term between you and your suppliers. That's the days payable that we are going to subtract. Formally, the formula is the cash conversion cycle is day sales outstanding plus days in inventory minus days payable outstanding is going to give you the cash conversion cycle. In other words, the way we define cash conversion cycle is accounts receivable divided by sales for the entire year. We are going to convert everything to days, so we multiply everything by 365. That's days sales outstanding. Average inventory divided by cost of goods sold. That's going to be your days in inventory minus days payable outstanding, which is accounts payable divided by cost of goods sold. That's going to give you a cash conversion cycle. You may ask why there is a minus here, because these two, you are going to wait for them to come. You are going to wait for the customers to pay you. You are going to wait to get the inventory and sell, but you are going to shorten that time period by practically paying your suppliers a bit later. So that's basically the typically the cash conversion cycle in place. Some companies like Apple and Amazon make and sell their products before even they pay their suppliers. So that makes the cash conversion cycle negative. So when we come back here, this is so large for companies like Apple and Amazon that their average the duration they wait for their receivables to come in, or the duration they wait for to sell their inventory, is comparatively lower than what they pay to their suppliers. As a result, their cash conversion cycle is negative, and they can use that money to invest in something else. They typically use that money as well. So why do we use this in these types of metrics? Are we the key questions we are asking is, are we collecting too slowly? Are we letting the inventory stand on our shelves longer than benchmarks, or longer than what we are used to do in the past? Are we paying bills faster than we need to? Those are the types of questions we typically analyze. And each component, again, receivables is DSO, the inventory movement is DII, and the payment is DPO. Those will answer these types of questions specifically. Then we have financial ratio analysis. We understand the financial health of a company through different metrics. Financial ratio are typically used for companies' performance and financial health. They provide insight into profitability, liquidity, leverage, and efficiency. We can use it vertically, which means basically, or horizontally, I should say, which means basically we can compare the same company across different years and how these specific metrics are performing year over year. Are they getting better or are they getting worse? Which I have an example for it. Or you can use these metrics to compare it against the benchmark or against the industry. So what are these ratios? They are grouped in 5 main categories. There are liquidity ratios, profitability ratios, leverage ratios, efficiency ratios, and market value ratios. So just again, how to use the financial ratios. We can compare it to industry benchmarks. We can analyze trends over multiple periods. We can combine multiple ratios for comprehensive review, and we can consider economic and industry conditions. And I mentioned liquidity, profitability, leverage, etc. So what are the examples? We are going to go over specific examples, but liquidity is typically measured with current ratio, quick ratio, and cash ratio. Profitability is gross margin or return on assets. Leverage is measured by debt to equity ratio or interest coverage ratio. Efficiency is typically measured by inventory turnover or asset turnover. And market value ratios is typically measured by price to earnings or market to book ratio, or some other ratios as well, like that we are not going to go into detail. So let's look at these individual ratios specifically. The current ratio measures a company's ability to cover short-term obligations with its current assets. And the formula is current assets divided by current liabilities. Typically, we want to have this greater than 1 or even greater than 2 to make sure that the company has some type of liquidity. Quick or asset-based ratio is a stricter liquidity ratio, which basically takes current assets but subtracts inventory. Why inventory? Because inventory is hard to sell if you want to cover your current liabilities. Inventory may be hard to sell. Cash is obviously very liquid. Accounts receivable, you can do factoring or other financial instruments. You can sell your receivables if you have to. So those are easy to convert. That's why this is a bit stricter compared to current ratio. And cash ratio is the most strict one. Basically, it measures the ratio of cash and cash equivalents against your current liabilities. Can you cover your current liabilities with cash on hand? That's what the cash ratio answers. Then we turn our attention into profitability, which is there is 2 gross margin and return on assets. As I explained at the beginning of the video, gross margin is basically the gross profit, which is revenue minus cost of goods sold, and gross margin is gross profit divided by revenue. Return on assets, on the other hand, evaluates how efficiently a company is using the assets, which is net income divided by total assets. Per $1 of assets, how much income am I generating? That's what return on asset is answering. Then we have leverage ratios. These ratios are important to see if the company is solvent or not. The most famous one is debt to equity ratio. You take total debt divided by total equity. That's going to give you a debt to equity ratio. Almost all firms have some form of debt. Debt is an essential part. Even with companies like Apple or Google, they have a pile of cash, but because of some tax reasons, etc., they still have some type of debt, or for operational reasons. So the idea is not to have zero debt, but the idea is to have a debt at a certain limit. That's the idea. And then there is interest coverage ratio, which is basically you are going to cover your interest expense. How are you going to cover your interest expense? You are going to cover it with earnings. And EBIT is earnings before interest and taxes. So it's not exactly net income, but income before earnings and taxes divided by interest expense is going to give you an idea of how much you can cover your interest expenses. That's the idea. Then we have efficiency ratios. Inventory turnover is one where we have cost of goods sold divided by average inventory. That gives you an efficiency ratio in terms of how much inventory you are cycling in a given fiscal year. The other one is asset turnover. Net sales divided by average total assets. How much sales are you generating per $1 of asset is the question. That's another metric of efficiency. And then we have market value ratios. Price to earnings is the most famous one, which is per $1 of earnings, how much value is the market giving in terms of a price of a stock. So you take the price of a stock, you divide it by earnings per share, you get the price to earnings ratio. Typically for growth companies, the PE ratio is high because of the growth. Earnings are not there yet. As a result, investors are willing to pay more price for a dollar of earning. And then there is market to book ratio, which compares the market value of a company to book value of the equity. By definition, it's the market value per share divided by book value per share. The last piece I want to cover in this video is horizontal and vertical analysis. As the name implies, vertical analysis looks at a specific vertical and calculates specific ratios. For example, this is a real example, actual example from Apple Inc.'s balance sheet. You can calculate debt to equity ratio by taking the debt. Total liabilities turn out to be the $290 billion dollars, and then you have total equity, which is $62 billion. You divide the two, you get some type of debt to equity ratio, which is 4.67. And then you can also do a vertical analysis, a horizontal analysis, by practically looking at how debt to equity ratio is trending. As you see, if we go from right to left, which is, the years get closer and closer. We start with 3.696. It keeps increasing, which is kind of not a red flag exactly, but something we need to be careful about. But then in 2023, it decreased, which is a good sign. We don't want the debt to equity ratio increase forever. We want to keep it at a stable level. Current ratio was another example I took, which is basically you take the current assets, which happens to be 143 billion, and divide it by current liabilities, which is 145 billion. And on the vertical analysis, you get 0.99. If you do it horizontally, you look at it, the current ratio decreases up until 2022, which is not a good sign. You want to typically keep the ratio, current ratio, which is the liquidity ratio, around the same or increase a little bit if necessary. And then in 2023, just like debt to equity, things started getting better from Apple's perspective and current ratios started rising. So that's what I want to summarize in this video. Again, we covered the horizontal and vertical analysis. You can do it for balance sheet or for income statement. And we covered the practically the important ratios we get from the financial statements, namely income statement and balance sheet. I highly recommend you going over these examples, the explanations and the formulas to make sure that you understand each concept. This is pretty much it for this week, and I will be talking to you next week. Thank you.